Hi everyone. Today I'm going to talk to you about how to do option trading. So basically, I've been doing stock trading for like over 3 to 4 years now, and recently I got into option trading. So I was not doing option trading because I was scared. I was, there's a lot of things to learn, and there's a lot of technical knowledge that need to be built for option trading. So I was scared for that. I was going through some tutorials on YouTube where I was, listening some, podcast around option trading, but I was never been able to do that. But recently, probably a month or so, I really got into option trading after like a year worth of, off and on learning some tutorial and all that. So I'm going to share, my experience and how I get into option trading. And, I'm now expert, and this is not any advice to do option trading or buy any stock or any particular example that I'll be going through, any kind of suggestion for any advice for our financial advice, but it is all about education and tutorial, and just talking about how these things works, and how what is my experience and what I'm doing with my account with option trading and all that. So today I'm sharing my screen on Robinhood, but Robinhood is just one platform, brokerage platform that lets you buy and sell stocks as well as options, and it's pretty good. It's pretty user friendly. But also there is a lot of different other platform like Fidelity or Charles Schwab. They have platform TD Ameritrade. These are also there are a lot of other brokerage firm like Tasty Trade. They have platform like that. So anyway, it doesn't really varies a lot in terms of how trading is done based on the platform. It's all about usability, and how user friendly these are and how easy it makes you to do the trading. So that's how all the different platform. I find Robinhood pretty easy, but it's not about that. It's about option trading, right? So let me start talking about first, the buying and selling stock, right? So just to for everyone, by when we buy a stock or sell a stock, there is always two parties, on the opposite side, right? So when someone buys a stock, somebody is selling the stock, and when somebody is selling the stock, someone else on the other side is buying that stock, right? So that's how the stock buy sell happens, any of the exchange. And you can buy a single stock, or you can buy an ETF, which is a bucket list of underlying stocks that it follows, right? So stock and ETF, you can trade during the trading hours, and then you can buy and sell as you please, right? Um, so that's stock trading, and you go buy Apple stock or Google stock, or any other company stock like Facebook or ExxonMobil or Coca-Cola or whatever. But the thing is that at that time what happens is that, so you are buying each individual stock, you are also buying each individual stocks quantity, right? So you're buying, let's say 100, 200, 50 or 10 or even one, and some platform also allows like buying fractional stocks, right? So if I see Apple stock is $180, I have $100, so 100 divided by 180, that percentage of stock can be bought also, right? So that's how the stock buying and selling works. And but the option is a little bit different. Option is about a contract buying and selling, right? So a contract is an agreement between a buyer and seller, right? And then how that contract, what does it mean by a contract? A contract is like an 100 stocks. So for any contract for any stock, that would be at least 100 stocks, 100 count of that stocks, right? For example, if I say I sold a call on, and I'll get into the what is call and put and all those things, but just say I'm selling one contract of Apple stock. That means that I am actually talking about 100 individual Apple stocks. Similarly, Google or Amazon or something like that is always be 100 stock. Now, it could be multiples of 100, like, for example, 200, 300,000, whatever it is, right? It has to be 100 and upwards, and in multiples of hundreds, right? So in two contract means 200 stock, three contract means 300 stocks, right? So that's how the transaction works, right? I buy a option or sell a option. Basically, I'm buying 100 stocks of that particular ticker, or Apple or Google, or I'm selling a stock. I'm selling 100 count of that stocks. So that's how it works, right? So now, so a couple of things. So stock trading is not, is easy, right? You have you want to buy Tesla stock, you go there, you see, okay, Tesla stock is $200 right now. You buy 10 stock, you pay $2,000, you buy that. You have now Tesla stock went up to 250. You say you want to sell those 10 stock, you sell that, you get $2,500. You made a $500 profit, and like that, right? So you can buy and sell during the weekdays, during the trading days and trading hours, and whatever you can buy partial share stocks. You can also sell partial stocks, right? So you can do those things, right? But contract, as I said, it's always 100 stocks at a time, right? So any contract is 100 stocks. So you have to sell like one contract, you have to have 100 stocks. And then this is just for the simplicity, I'm just letting you know there are other options. But when you want to buy a contract, you're buying 100 of that particular company stock, right? So that with that established, so option trading is done through a unit of transaction using a contract. Each contract has 100 stocks at the minimum. So one contract equal to 100 stocks of the underlying companies, right? So when I say one contract of Google, it means 100 Google stocks. When I say one contract of Apple, it means 100 Apple stocks, right? So now there are two basic terminology about option trading that need to be understood, right? So they are called, in this, there are different name, but it calls call and put. So what is call and put, right? So call and put is about two basic transaction that can happen using the contract of a particular stock, right? So for example, if I say, I am, buying a call of Apple stock at 175, right? So these statements, let's take it apart, right? So when I say buy one contract, buy a call of one contract of Apple stock at $175, this is what I mean, right? So if I search in the with the sticker, I see the Apple, I hit here, trade Apple options. So you see that, this is basic buy in stock, sell and stock. But when you want to option trading, you click here, trade Apple options. And you see there is call and put are listed here, right? So call and put, right? So these are basic thing, but there is more advanced stuff that we'll get into later. I'm also still learning, but I just went through the basic stuff, and I'm using a month or so. I did some transactions, and I have been successful so far. I mean, successful is like a big term, but I would say, like, I'm not expert yet, but I'm just sharing my learning, right? So okay, so you can buy and sell, but you can buy call, or you can buy a put, you can sell a call, or you can sell a put, right? So if I select buy, I can select call or put here. If I select sell, I can select call or put here, right? So that's how it works, right? Now, what is when I say buy a call, right? So let's get into the first one, right? So buy a call, what does it mean? And there are a lot of things to talk about buying a call. There could be multiple videos just about talking about call, right? Buying a call means is this, right? So when option trading, one thing that you have to have is some kind of idea where the market trend is going, or this companies going. Let's talk of this companies going, right? For example, Apple. So for example, let's say you are typically, today you are bullish on Apple, or you think that Apple stock will go up in near future, in coming weeks or coming month or even coming days, or it could be years. That Apple stock is going to go up. You're bullish on Apple stock, right? You think that company is doing good and all that, and you think Apple stock will go up. So right now you see that Apple stock is 179.05 cents, right? That's Apple stock. I think it's afterwards price, but let's say that's a stock price right now. But you say you think that Apple stock will go 180, 200 and 300 or whatnot, right? So but then you want to buy Apple stock, but you want to buy Apple stock right now, and you want to say, what, instead of, I could buy Apple stock right now, let's say $180, and if I buy 100 stock of Apple, I have to spend $18,000, right? So if you want to buy 100 stocks of Apple, today's price would be $18,000, right? So let's say you don't want to do that, but also you want to say, what, I'm going to I'm bullish on Apple, but I'm going to be not purchasing immediately the stock, because what if the stock goes little down and it's not, I proved wrong. So you don't want to spend $18,000 and say, you know what, I'm going to wait when stock goes down, and I feel sorry that I've done something wrong, and I want to sell, immediately cut my lose, and I lose money, right? So instead of putting 18,000, but you still want to hold or buy 100 stocks of Apple, you say, you know what, I'm going to buy Apple stock at 180, 100 of that stock. So I want to buy one contract, right? So 100 stocks equal to one contract I want to buy, but I don't want to buy, at a price that is now, but I don't want to pay $18,000, right? So if stock goes up, I make profit. If stock goes down, I just don't buy the stock. I don't pay $18,000 and lose money, because stocks go down. Theoretically, Apple stock or any stock can go down to zero, and then what will happen? You lose $18,000 on that stock. So you don't want to do that. Even if it's like go 160, you lose $2,000, right? So you don't want to do that. So you want to make a minimum investment, but you still want to buy today's price 100 stocks of Apple. So what do? You buy a call. So you buy a call, you say, you know what, I want to get into a contract where I will buy 100 stocks of Apple at $180. And then what I do is that I actually buy a call. So you select buy, select call. You say, you know what, I want to buy, let's say, 180. This is strike price. I'll define all those things later, but this price is what I'm going to pay for Apple, 100 stocks. And now that Apple stocks is, typically people are bullish on Apple stock. So when you say, I want to buy Apple stock at $180, you have to pay a premium. Why you have to pay a premium? Because whoever is selling you the contract is saying that, hey, you know what, Apple price is going to go much more than $180. So if you want to buy that stock, buy the contract right now, you have to pay a premium to me because I have the 100 stocks of Apple. I will give you at $180, and for that you have to pay me a $2 premium. Now, this $2 premium, what does it mean? It's $2 premium each for each stock. So basically, you are talking about one contract, 100 stocks. So basically, you have to pay 2 into 100 for one contract, 100 stock, 2 into 100, so $200, right? So today, if I select this plus sign, you will see here that I'm buying a right to buy 100 stocks of Apple, which is one option contract. I'm buying a 180 call before June 9. So this contract will expire June 9. So June 9, I won't be able to buy this 180 stock. If I don't buy within like today, between today and June 9, this contract will expire, but and I lose $200, right? But I'm getting into a contract where I say, you know what, between now and June 9th, I can buy Apple stock, 100 of Apple stock, one contract of $180. And no matter what price of Apple is, right? If price goes 185, 190, I'll still pay $180. So that's the beauty of the buying a call. You pay a premium. So if you see here, if you select one contract, limit price is $2, which is like, okay, premium price also changes. So it could be $2, it could be like a little more than $2, a little less than $2. So you're saying, okay, I would buy one contract of Apple stock, which will continue, which will have 100 stock, and then I will not pay more than $2, right? So you don't want to keep it open in a market order because the option price can spike very fast and you don't want to pay a lot of money. But I would pay $2. And you see that here is the bid and ask, right? So basically, whoever is selling the contract is asking $2. Whoever is trying to purchase, like myself here, is selecting $1.96, right? So it's kind of like a buyer seller, kind of like a negotiation going on here. Sometimes people, mostly what I've learned so far, that I'm choosing in the middle so that I have a more chance of getting that contract request fill up. And also not paying the maximum money, which is like for here, the bid and ask is the maximum and bid is lowest. So maybe I'll do 1.97 or 1.98, something like that. And right now this is off hour, so it's a good for day because it will start tomorrow and finish tomorrow. But I could put that order like until like good till I cancel and all that, right? So your order will continue as long as people it's not filled. So but you see the max cost. So by having the ability to buy 100 of Apple stocks, which is one contract, using long call, you are actually having this luxury of that. Even if stock price goes up, you still not pay more than $190 per stock. You are paying this premium, and your total cost for this transaction is $200. So you $200 will be debited from your account, and you will have this call option listed on your account, on the stock price list, on the stock list, all the stocks that you're holding. You will see in your platform that you will have this, that you have the now thing about call and put is that you have the privilege of buying this, but you may not buy it. Like, for example, when you will not buy this, even though you are paying $200, when what situation you will not buy this 100 share of Apple or one contract, right? And you let it expire, right? Let pass June 9 and you still didn't buy Apple stock. Let's say Apple price goes down, like Apple price becomes like $170. So $170 each stock will be $10 less from the price that you are asking to pay, you are willing to pay, right? So you'll see the market price is 170, but you bought a call of 180. So you have privilege of buying Apple stock at 180, but the market price is 170. So no way you will buy that $10 per stock more than market price just because you have the call, because you paid $200. But if you buy $180 stock instead of 170, that's like 10 into 100 stock, right? So $10 difference on each stock. 100 stock is like $1,000. So you lose $1,000, but you'll never do that, right? You let $200 loss, but you will not make another $1,000 loss. So basically, you will let the contract expire. You will not buy that 180 call, and you will just if you want to buy, you can go in the market and buy $170 stock for Apple with $17,000, right? Instead of $18,000, right? So, but what if the Apple stock goes 185 or 190 or whatever, above 180, right? What in that case, between now and June 9th, you can anytime buy that stock. You can execute that right for the buying the stock, and you can buy $180 price stock of Apple, and you pay $18,000 and you buy the stock. Now let's say Apple stock went 185. You see the market price today is 185. You have this call, you execute that, you pay 18,000, you buy 100 stock, and you immediately sell the stock at 195. You made $5 each stock, 100 stock. You made $500 profit on that call, right? So it could go 190, then you make $1,000 profit. Now, if you make $500 or $1,000 profit, what will happen is that you already paid $200 premium, so that is already debited from your account. So your actual profit, if you sell the stock at 185, will be $500 minus $200, because $200 is gone. That is not coming back to you. So you will see that you will actually make your profit would be 500 minus 200, which is 300. If you sell at 190, with $1,000 minus 200, which is 800, right? So what is happening is here you see that Robinhood. That's why I like Robinhood very well, that because it's already showing you that what is your break even. So break even is something that above which you make a profit, right? So you see that you go this way, you can make infinite profit, but your loss is becoming constant, and it's like you make this much of a loss, right? So what is the loss you can make? So loss you make that you lose that the premium that you paid, which is $200. So your loss is limited, only $200 you can lose, because you are not going to buy the stock if stock price is less than 180, and because you already paid $200, and that will be gone. The contract will expire worthless, and you lose $200. But that's the maximum loss you can make from this transaction. But the profit is that once the stock is $182 and more, because you are asking to buy Apple stock of $180, but you made it $200, which is 200 divided by 100. For each stock you paid $2 more as a premium. So here that $2, and you buying the right of buying Apple stock of $180. So basically 180 plus 2 is 182. So as long as stock is above $182, you are always continuously making profit, right? As price goes up from $182, you make profit, right? But if it is below $182, you make loss, and the maximum loss you can make is $200 when the stock price are below $182. So that's one good thing about this, is that your capped loss is $200, but your your profit potential is huge, because who knows, the Apple stock suddenly one day become like $200, and you made like, okay, I bought in 180, $200, $20 per stock, $20 into 100 is $2,000, minus $200, I made $1,800, right? So this $200 can become like anything, right? Theoretically, it can go to the moon, and you can make a lot of money. But ideally, to be realistic, I mean, let's not talk about theory. Let's talk about, like, stock go 185 or 190, you make $500 or $1,000 minus the premium, you make $300 to $700 or $800. I think it's a good way of looking at this. But you always know that stock price can go down, and you make this $200 loss, right? So that you have to keep in mind, that here, one thing, that you are buying 100 stocks of Apple. So are you looking at this stock price to go up? Are you bullish on Apple? And that's why this it's calling long call. Means you are long, means you are bullish on this stock. You want to hold this stock. You want to purchase this stock. You have intention of holding 100 stocks of Apple, right? So that's where it's a long call. And there is also short call, when actually you're selling the call instead of buying the call. Because when you are buying this call, somebody on the other side is saying, you know what, I think Apple stock will go down. It's $180. So I'll sell you at $180 because I think the stock is going to go down, right? So that's another person is bearish on Apple and selling that. So for him or her, it will be a short call. For the other side of the person, that whoever is selling this, right? So that goes to the call side of things, right? And what about put, right? So put is opposite of call, right? Put is like, you are telling that, I'm bearish on the stock. I know that Apple stock is going to go down. It had a huge run. Now it's like, having 52 weeks high or something. It's hitting some resistance. And I want to, sell the stock. I don't want to keep holding it. And you then, buy a put, means that you say, I'm going to sell this stock at 180. So you see, by, you can also select anything like, buy a put, select the expiry date, and then you go here, and you can buy, cancel this one. Yeah. So here 180. So you say, you know what, I want to sell this 100 stocks of Apple, which is one contract, and I want to pay $225, because $225, what it is giving you is that you're saying, long put, I want to sell this stock at $180 because I think the stock is going to go down, and I'll be able to sell the stock at 180, because if it goes down, I'll still be able to sell at 180. That's the price I'll get. So I'm safe, because if the stock take downturn, I'm still making money, because I'm having a put on Apple stock at $180, right? So let's say Apple stock 170, but you will still make if you buy this put, you'll still see that you'll make money if stocks is lower than 180, and you'll see that also creates a break even. Like, for example, here is like, $225 is a premium, $2.25 per stock. So 100 stocks, $225. So your break even would be like 180, which is you are selling the stock plus minus the premium that you're paying to get this right of selling the stock at 180, right? So 180, you will not get 180, you will get 180 minus 2.25, $2.25, which will make this stock is 177.75. So you'll get 177 and 75. If the stock price go below than that, I mean, then it's no point. Like, nobody's going to purchase the stock from you, because they can purchase the stock from the market with the lower price, and you will make the loss. But if it remains above 177.25, then what will happen is that you will make money as the stock price is going down, right? So that is the good thing of this, is that this is a good way of protecting. In another way that I've seen people come, or some of the internet is talking about buying a put is basically buying an insurance on on the stock that you want to hold, right? So for example, if you say, no, I have this 100 stock, but I think it's going to go down, but I want to keep my money, the price that we have now, then you can buy a put and say, you know what, no matter how much the price goes down, I can still make money, right? So that's another way of looking at these things. So your profit potential is huge, and you'll see that as stock price go down, your chance of profit is more. So anyway, so this is how the buy, call, and put works. It's a very simple part of the option trading, but there is a lot of other things like what if that the stock price is very low, and then you nobody really actually purchase the stock, and you incur the loss, because even if you were not selling the stock, I mean this you will see that price is going down and you are showing as a loss, right? So loss and profit, it doesn't happen unless you execute on that, right? So for example, if I have a stock I bought at $10 and it's now $30, but doesn't matter, I will not make $20 extra profit unless I really sell at that $30, right? So no matter how it's showing in a screen that I made $200 profit or $2,000 profit, it doesn't matter unless you are really selling the stock, or in other terms, you are not making loss also if price goes down, unless you really sell the stock, right? So you have to make sure that you mental makeup is that if I working with a very good company. Well, another thing I want to talk about is that no matter stock and option, one thing doesn't change is your understanding of the market trends, and also like good company, right? Who are the worthy company of trading, whether it's option trading, whether it's a stock trading, right? So that doesn't change. So if you have a very good knowledge on choosing the right company to trade or invest, that doesn't change. In option trading, also stick with those companies that you think that are market leader and very good company. Like the couple of things that I follow as a good company is that the product that people loves to use, product that people are ready to pay money, product that they people if they increase the price, people will continue to stay. Like for example, Netflix, right? I'm paying from like $7.99 to $9.99 or whatever right now, but it remained with me as the increasing the price. Amazon Prime was like 60-70 bucks, now it's $120 a year, but I never think of going back and cancel Prime just because it increased a lot, the subscription fee and all that, right? So those are the company, like Microsoft has been there forever as a technology leader, and continually innovating and bringing new products, who has Apple, Google, Nvidia, and GPU and their chips for AI and ML. I mean, these companies are so good and doing very good. So I do option trading with also those companies that I as an investor I invest, right? So in one part of my life, I'm an investor. I buy those stocks as the stock price goes down, and I don't touch them, don't deal with them. But another part of me is doing like trading, where I have a short term, like 1 week to 6 weeks kind of a situation where I kind of like buy options, sell options, and all that, right? But so this goes call and put. So to summarize, option trading is a transaction between a buyer and seller via one contract or multiple contracts. Each contract means 100 underlying stock. That could be any company stock. You either buy or sell, call, or buy and sell put. The call is where you say, I want to pay this much of money. If the price goes up, I will make profit, and for that I'm ready to make give a premium and buy the call to buy the right of buying a stock at certain price. Whereas put is that you are buying a right to sell the stock at certain price, and you think that if price goes down, I'll still make money because I'm buying the right to sell the stock at a higher price, right? So, and for that right that you are having, which is a privilege, you are giving a premium, right? So whoever is selling the call to you or selling the put to you, they are making money from that premium, right? So it's always people who are buying and people who are selling. Option and stock in that sense is not different. So somebody is thinking opposite direction of the market trend or the stock trend of the company trend, and doing a transaction with you, right? So that's buy, call, and buy, put. And I think next video I'll go over with the sell side of things, and you will see that if I select sell and call, you'll see that in a long. So hold on, let me cancel this. Yeah, so if I sell a call, let's say 185 of Apple, you'll see that is a covered call, which means that I'll go in the next video, but there are a lot of other things that need to be understood. I'm also learning. There are a lot of vertical put spread, debit spread, poor man's covered calls, and all those things. So we'll go on the other video, but this is basic stuff. So a couple of things that I want to summarize: that your understanding of the market, your understanding of the companies, quality companies, future outlook, companies, what I say that, the strength of cash flow and their business, the health of their finance and all those things. Those understanding is still applicable, very much applicable for option trading. So that doesn't go anywhere lost or anything. Like if you did a lot of analysis on some companies and you're bullish on those companies, you should stick to those companies for option trading. But you can be little more frequent, little more short term, and make money on those companies, right? So what I'm doing in my case, right, I'm bullish on a lot of different companies, and probably I can show you some of my companies that I'm bullish on, and this is not a financial advisor or anything. This is what I'm doing, and no way I'm asking anyone to follow me. But just to show and as an example for analogy purpose, is that I'm bullish on some of the technical companies that have been probably most of the people knows the name: Apple, Google, Amazon, Microsoft, Nvidia, Tesla, and some Bank of America, Goldman Sachs, JPM, JP Morgan Chase, some of the company like Palo Alto and CrowdStrike and all that, right? So I a little bit familiar with the tech world, and I mostly trade with or invest with the tech companies. So that's how I'm also doing option trading, right? I'm not changing my understanding on the companies and the market trends. I'm using those in the option trading from the stock trading. So that's not much different there, but I'm just learning the technicalities, because stock trading is, I think, much simpler than option trading in a way, because if you are bullish on a company, if you have a long-term vision, you just continue to buy the stock. As price goes down, you buy more. Whenever you have money, you buy the stock, you continue to hold, you'll make money, a lot of money in the long run, right? And that's another way around is that option trading is not that simple, right? So there's a lot of technicalities, a lot of volatility, all those things, and then a lot of technical aspects of these things, which I'll go later on, right? How to see some of the indicators, right? So in the market, implied volatility, or probability of success, all those things. And some of the things are are technical in the terms of they may symbol, there's a symbol like Greek symbols that they use. They call option Greeks, like delta, theta, gamma, and all those things. So we'll go over on those things later. But so, I just want today anything to take away from this video is that option trading is like a stock trading. There is a buyer and seller on both sides. The buyer and seller is doing a transaction using a contract. One contract is 100 stock of underlying company, Apple, Tesla, Google, or whatever. And there's a call and put. In call, giving you right, not an obligation, to buy a stock at certain price, whereas put is giving you right, not an obligation, to to sell a stock at certain price. So when you are if you know the stock is probably will make move higher, you buy a call. When you think that stock might go down, you buy a put. So basically, put is bearish, call is a bullish strategy. So this is like based on how you are putting call and put, or sometimes combine those, and do a lot of different price that you choose. This could get very complicated, and has a different name like butterfly spread and all those things, right? So there's a lot of name, and those names are also not consistent, right? So many different platform has different name to say the same thing, so that get really muddy. And I'm really working through this right now, so I'll make more videos on that. And a couple of things that I want to talk about, like when I said, like we want to buy a right to buy Apple stock at $180, knowing that stock price can go up. What is that $180? That could be any amount that you want to choose. That is called like the strike price. So for example, here, if you go to trade option and say buy a call, all these are strike price, right? So this is the price, means this is the price I will buy the stock if I want to buy, right? And for that I'm paying this 51 cents the premium. So whatever I'm paying or somebody who's selling the call is getting is the premium. So that's the money you are making, is income that you are making. But your the stock price that you are choosing to buy that stock or sell that stock in case of put. So if you do a buy put, you are buying the right to sell the stock at $185, and making giving that, for that you're giving $6.30 for each stock, which is total $630 for one contract through put. But this is strike price, and this is the premium that you are paying, right? So for call, you are paying this premium to buy a right, not the obligation to buy the stock at $185, right? For put, you are paying $630 for having a right to sell the stock at $185, so that your bearish stock goes down, you still can sell at $185, not obligation, but a right to sell the stock at $185. For that you are selling, you are making giving a premium of $630, right? So that's how it works. And another thing is the expiry date is important. Expiry date is when this contract expires. So contract cannot be infinite and open, right? It has to have a certain expiry date. The expiry date can go like a lot of different date. You're saying 972 to 2027 date. I think it can go beyond that. But you choose a contract date when the contract expires. Whether you are buying a call, you're getting into a contract is the expiry date. So you say, I'm buying a call to buy Apple stock on $180. I'm paying $200 for that. But after June 9, that contract doesn't remain. So you don't have the right anymore to buy the stock at $180. And if you didn't buy, that $200 that you paid as a premium is gone. So that is your loss. And then whoever is selling the call to you, he made that $200 money doing nothing, not selling the stock to you. And he has the stock as it was before, but he just made $200. So that would be your loss, right? So similarly, right, selling put. So you buying put, you say I would sell the stock at $185, but you never sell that stock. Stock price is higher. You put sold in the market in more than $185. You so the stock is now $190. So why would you sell that stock at $185? Stock price is higher than that. You won't execute that, and what will happen is that whatever premium you paid for buying that put, that seller of the put will take that money from you. So the premium will be gone to him or her or anyone in that sense, and then you lose that premium, right? So that's premium and strike price to you. So choosing the right strike price, choosing the right expiry date is very important, very, very important. And that's where the some of the knowledge and investigations and analysis will come into the coming to help you, right? So I'll go next one, by selling call and selling put, and also like in technicality, what is that each delta means, and I share some of the documentation I'm doing, like for tutorial, just for my own benefit, just in case if I forget something and I go back to this. And I'm very good at keeping, as I'm learning something, I always make a note of those things so that I can go back always and revise my memory, or clarify my understanding again, so that I don't do a lot of mistakes, right? Having said that, thank you very much. And if you're listening this trading, one thing I suggest that do not go jump on doing option trading. If you are in the stock market, if you're doing stock trading, keep doing that. Build your knowledge and understanding of the market, understanding of the company. Option trading will come definitely as the more knowledge will be built, and play very safe and all that, right? So do not just I have been looking at option trading for a year now, and then finally I could go and took a very conservative approach, only trading the company that I believe that will go up. Yeah, if the stock price goes down and I have some option open, I know those can expire, I make a loss, which is limited, but also the stock price in future will go up. So that's why I'm doing very conservative option trading, just to make sure my understanding works. And then, I'm also like, documenting everything. So if I share my option trading platform here, where I'm kind of keeping track of all my transactions. If you see, here is all my transactions. So there's a stock price, how much I paid to purchase those. What is the current price? What is the premium I'm paying, buying, and what is the profit and loss I'm making? I'm writing whether there's a profit or loss. So I'm kind of so far I haven't made any loss, but you see that only few transactions I've done. So it's not a lot, or it's not to show anyone that how good I am or bad I am in this context, but I'm just showing that keeping track of all your transactions, learn from your past mistakes or even past success is very important. So if you really get sometime get into option trading, after you really feel confident, make sure that every transaction you are doing, keep a track of that, and that would be a biggest teacher later on, right? So learning from own success and failure are like biggest teacher, right? That's what I believe, right? So okay, thank you very much, I appreciate that. Thanks for your time, and good luck.